Hello and welcome to this budget special edition of the Market Update video. I'm Rachel Winter, one of the investment managers at Killick & Co, and I'm here today with our Head of Wealth Planning, Shaun Robson, and our Head of Financial Planning, Will Stevens. They've been very busy looking through the 164-page budget document, and we're here today to talk about some of those key takeaways. So Shaun, let's start with you. I know one of the areas that our clients have been quite concerned about in the run-up to the budget has been pensions. So can you tell us what people were worried about and whether that materialised?
Yeah, thank you, Rachel. In the run-up to the budget, there was lots of speculation. There was lots of time between the general election result and budget day, and that has left lots of room for press speculation in terms of what changes might happen in the pensions landscape. And that has had lots of clients worried, particularly around things like tax-free cash, whether that's down to how you fund your pensions, and equally sort of death benefits on pensions. And actually what we saw from the Chancellor yesterday was probably the biggest change we've seen in pension legislation for over a decade. She's announced that she will reintroduce IHT on pensions from April 2027. Now that's a fundamental shift for pensions. If we look at clients' approaches to how they manage their pensions, perhaps over the last decade, it's very much been a case of, for the majority of clients, seeing the pension as an asset of last resort and seeing that as perhaps a tax wrapper that they will only really touch themselves should they need to amongst their other perhaps investments that they have. Now that approach really does need to be reconsidered over the coming 2.5 years when this change comes into force, and then maybe some consideration needs to be given to whether that's still the right approach for you as an individual, or whether it might make more sense to start drawing some of that pension income during your own lifetime. So a real big fundamental shift for pension legislation in the budget yesterday.
And on the investment side, I know lots of clients have historically invested their pension on quite a high risk mandate because they think they have a long time horizon and they don't plan to draw on that pension themselves, but that could potentially be changing now. Anything else from an estate planning point of view that clients should be thinking about?
Yeah, so in addition to pensions being brought into the IHT net from 2027, a couple of other changes from an inheritance tax perspective that clients should be aware of. Firstly, the exemptions that every client gets, which are called the inheritance tax nil rate band and the residence nil rate band, which sit at a level of £325,000 and £175,000 per person, have been extended and frozen out to 2030. So no changes there other than the fact that they will continue to remain in place. And I think when we're looking at speculation pre-budget, there was some concern that those perhaps would get removed or changed and make the impact of IHT bigger. Now, in addition to those thresholds, there was also the introduction of a cap on assets that qualify for both business relief and agricultural property relief, which has now been set at £1 million. Previously, that was uncapped, so that could have a big impact on clients, perhaps that were holding investments that qualify for business relief or APR, and perhaps also any clients that are perhaps family business owners and were looking to benefit from those reliefs as part of their succession planning. The last big impact really is on investments like AIM qualifying investments that historically had a full exemption or 100% relief from inheritance tax. There was no inheritance tax to pay on those assets if they were held on death and had been held for 2 years. That relief has now been sliced in half to 50%, and therefore the effective rate of IHT on those assets going forward will be 20%, not 40%.
And we've seen that playing out in the market. So before the budget, the AIM index performed very badly because people thought all that relief would be taken away. But now they know there's only going to be a 20% tax rate. We did see the AIM index rise 4% on the day of the budget. Now over to you, Will. Another of the areas where clients were quite concerned was capital gains tax. And I think a lot of clients were worried there would be quite a significant increase there. So can you tell us what actually happened on the day?
Yeah, absolutely. Before the budget, there was a lot of speculation about capital gains tax, with some reports saying it could go as high as matching that of income tax. That's not what we saw on the day. The reality of it was we saw an increase in the lower and higher rates of capital gains tax to 18% and 24%. That's up from 10 and 20% respectively. So a material increase, but nowhere near as bad as individuals thought it could be. We had seen a lot of transactions ahead of time where people were looking to lock in gains perhaps at better rates of capital gains tax. They now match that of non-main residents residential property, which has always been at that level as well. And just while we're on property there was an increase in stamp duty land tax surcharge for second homes as well. So those who have second homes or buy-to-let properties, they've sort of seen an increase in taxation on that side as well. So those were some of the other, I guess, bits of bad news that were within the budget.
And any news that was good or not quite so bad?
Yes, there was better news in there, particularly I think for those who are working and those who are looking to save and invest for their family's future. For working individuals, the good news is that income tax thresholds, which are currently frozen until 2028, will increase thereafter. So they will be unfrozen at that point and they will start to go up in line with inflation. On top of that, I guess the probably good news for savers and investors is that pensions and ISAs remain pretty much broadly untouched other than the inheritance tax implications. So the contribution levels, which are £60,000 a year currently for pensions and £20,000 a year for ISAs, have remained frozen and will do throughout this government. So some good news there for individuals who are looking to put money away. That was topped off by the fact that there was no introduction of any lifetime allowances on either of those wrappers, which again have been in media speculation beforehand. And I guess one final piece of good news for those who are looking to save and invest tax effectively was that the scheme that allows for investment into venture capital trusts and enterprise investment schemes, which are early stage UK businesses and receive tax relief on those investments, has been extended through to 2035. So some good news there for families who are working and looking to build their wealth for the future.
Great, thanks Will. Good to end on a high. Thank you to you as well, Shaun. And thank you to everyone for watching our video. Please do get in touch with your advisor if you have any questions, or you can email info@killick.com. We have got a written summary of our thoughts on the budget, so please do ask for a copy of that. And we've also got a webinar on the budget coming up on the 20th of November, so we do hope to see you there. Thank you.